What is good, trading floor family? Your boy Wildcard back in the booth? Orange kitten curled up on my hoodie? Rockstar cracked? Pre-market futures just started breathing. It's July 1, first day of the second half, and the tape already feels like it's trying to tell us something before the bell. TB's in the co-pilot seat. Brother, you seen what I'm seeing?
I'm seeing it. The SPY at 746.65, the Qs at 735.32. Tech is leaving small caps in the dust. IWM barely moved. That divergence is the theme of this first week of July. But what's got me awake at 4 a.m. is the Hammock hangover. Cleveland Fed President Hammock stood at the Sintra podium yesterday and said artificial intelligence spending is keeping inflation hot, and rate hikes might be back on the table. The market heard insatiable artificial intelligence demand and bought the Qs up 1.9%, ignoring the rate signal completely.
That's the million-dollar question. Conviction or denial? The only word that registered was insatiable. Selective hearing. And selective hearing gets corrected when the next voice at the same podium confirms the message. Kevin Warsh speaks at Sintra today. Same conference, same stage. If he opens his mouth and sounds anything like Hammock, that 1.9% pump becomes the top of the relief rally. The transmission belt is already here. The 10-year yield just hit its highest mark since 2015. MarketWatch had that headline this morning. That's the hose connecting central bank words to your portfolio. High-duration assets, semis, growth tech, the Qs, get repriced lower when yields back up. It's not a distant threat. It's already tightening.
Quick reminder, nothing we say is financial advice. We're two guys talking markets, not telling you what to buy. Do your own research, make your own decisions. Now, that yield grit is exactly where my head is this morning. Wave Trader Algo took two semiconductor names yesterday, Micron, ticker MU, and Alpha and Omega Semiconductor, AOSL. 4 signals passed all gates. The algorithm saw clean structural setups, momentum aligned, volume regime supportive. It doesn't read headlines about yields hitting 2015 highs. It just sees wave decomposition and says buy. But here's the tension. The 10-year at multi-year highs is a macro force that reprices everything on the risk curve. Semis are basically the highest duration assets in the market. If yields keep climbing, those entries get tested fast. I'm not betting on which side breaks first. I'm watching the collision.
And it's not just yield squeezing from above. There's a second shoe you flagged. The cheap artificial intelligence models coming out of China. That story keeps resurfacing since mid-May. If China can do artificial intelligence cheaper, the whole capex thesis for semis gets questioned from the cost side. That's a pincer move. Macro tightening on one end, competitive pricing on the other. That's why I'm not chasing the chip rally here. My paper gut call account is sitting on $9,891 cash. Nothing is screaming at me before the open. I want to see how Warsh plays. I want to see jolts at 10 a.m. Then I'll decide. But there's a tailwind. Nobody's pricing. And that's the defense build-out. $1.5 trillion budget request. The Pentagon is talking about SpaceX-ification of procurement, fast-tracking everything. Prime names, Raytheon, NOC, Lockheed Martin. They haven't even begun to price in the replenishment cycle from depleted stockpiles after Iran and Ukraine. That's a multi-year structural bid that doesn't care about yields. And then there's the stealth insight from Bloomberg this morning. The tariff defeat is a tailwind nobody is talking about. While copper traders brace for chaos, Nike just banked $986 million in refunds. That's real cash hitting a P&L. Tariff unwinding is quietly helping importers, even as commodity markets stay nervous.
That's the bifurcation. 2 different worlds. And that's why July will be about rotation, not direction. So let's run through the rest of the picture the way we always do. First, earnings. This week is genuinely quiet on the earnings front. No big name reports that move the needle tomorrow. No major beats or misses scheduled. So we won't manufacture coverage. If something pops after the bell, we'll catch it tomorrow. For now, it's a dead zone.
That means all eyes are on the economic calendar, and this week is loaded. Wednesday, that's today, we have JOLTS job openings. Consensus at 7.28 million, down from the prior 7.58 million. If the number comes in much higher, that signals labor market tightness and gives the Fed more reason to talk rate hikes. We also get consumer confidence, forecast at 94.4, up from 90.6. Watch that, because a confident consumer fuels spending and inflation. Overnight, we already got a flood of German state-level CPI reads, all pointing to steady or slightly cooling inflation. And the UK GDP numbers holding near consensus. Japan's Tankan survey showed big manufacturing outlook at 13, Still positive, but down from 14. So globally, the data leans okay, but the United States reads today are the real catalyst.
Adding to that, the sector rotation board is flashing a clear signal. Over the past week, healthcare is leading, up 4.26%, industrials up 3.97, tech up 3.44. Meanwhile, consumer staples down 0.78, real estate down 1.37, and energy getting crushed, down 2.48%. That rotation into growth and defensive healthcare, out of cyclicals and rate sensitive real estate, tells you the market is pricing reflation fears but still wants exposure to secular growth. It's a strange mix, and it mirrors exactly what we're seeing in our own signals.
And the international tape fits that cautiously optimistic tone. Asia closed mixed. The Shanghai Composite rallied 2.12%. China got a tech bounce. But South Korea's Kospi dropped 2.04% on semiconductor concerns, and Hong Kong slipped 0.63. Japan's Nikkei inched up 0.59. In Europe, the DAX is up 0.39. The FTSE flat. Euro Stoxx 50 barely negative. No panic, no euphoria. The dollar index ticked up 0.14%, and the yen carry trade risk is still muted. USD, JPY up just 0.06%. No unwind alarms yet. But if yields keep rising and the JOLTS print surprises hawkish, that could change fast and hit our names with carry trade exposure.
Which brings us to the portfolio hot news, the theme that's touching our book right now. It's the artificial intelligence CapEx inflation loop. The bull case, massive spending on artificial intelligence boosts productivity so much that it eventually cools prices, so yields stabilize and growth stocks re-rate. The bear case, the spending itself fuels demand-side inflation, forcing the Fed to keep rates high or even hike. And the high-duration names we hold, semis, software, anything in the queues, get repriced lower. This isn't theoretical for us. My Wave Trader algo is holding Micron and AOSL, both semi-names, and my TFT algo holds ASML, the big dog semiconductor equipment maker, sitting on $2,797 in unrealized gains. If yields break higher, those gains evaporate. My paper gut call account is in cash, waiting. That's my personal conviction that the macro risk is real, even while the algo buys the dip. The second order effects, defense names could benefit because reflation chatter boosts the industrial base, and tariff relief helps retailers like Nike, but not chip makers facing import costs. So our book is actively trading this tension. We're not hedging, just watching levels.
That's the honest setup. So here's what we're watching tomorrow. Number 1. Kevin Warsh at Sintra. Any echo of hammock in the 10-year yield could spike. Number 2. The JOLTS number at 10 M. Anything above 7.5 million, and the rate hike narrative gets louder. Number 3. The 10-year yield itself. If it closes above 4.7%, the rotation out of growth accelerates. And number 4. Friday's payrolls preview. If job openings hold firm, that sets up a hot non-farm print that could really move the tape. Keep your stops tight and your head up. I'm Wildcard. Remember, the market doesn't owe you a thesis. It gives you a price. Trade the price, not the story. We'll see you back here tomorrow morning. Go easy, but go.